Welcome to Trends with Benefits, a podcast by VanEck with a forward-looking perspective. We explore new ways of thinking about the markets, investing, work, and life. Here's your host, Ed Lopez.
Welcome to another episode of Trends with Benefits. So I found a couple data points that were kind of interesting. Year to date through July 2021, according to Morningstar data, there have been approximately $75 billion in flows into municipal mutual funds and ETFs. Also, there have been approximately $46 billion into sustainable mutual funds and ETFs over the same time period. Those are pretty solid numbers. Now, there are larger categories that have larger inflows over the time period, but those are really solid numbers for a couple of major trends that we've been seeing play out over this year. And on the sustainable side, it's actually been a multi-year trend. So that brings us to today's topic, which is actually kind of a confluence of both of those different trends. And we're going to be talking about sustainable municipal bonds. And I'm lucky to have as my guest today, Paul Herman, CEO and founder of HIP Investor. Now, HIP stands for Human Impact and Profit. And Paul himself, he is an author and a globally recognized leader in the idea of investing to pursue positive impact and profit. Paul, thank you very much for joining me today.
Wonderful to be here. Thanks, Ed.
How many books have you written now? Is it 2? Is that right?
I've written or co-written 2. So the first book, The HIP Investor, came out on Earth Day 2010. And the second book I co-authored, co-edited with one other and co-authored with 49 others, The Global Handbook of Impact Investing. And that's 1,300 pages. It's bigger than War and Peace. There's more peace than war, or at least more plans for peace than war.
I wanted to start out with some of the headlines, kind of before we even get into the main topic at hand and talk a little bit about HIP as well. But just this is also another interesting time because it's, we've just finished August 2021. We're into September now, but at the beginning of August, I believe the UN put out a report. I don't know if it was codenamed or actually called Code Red, but they basically identified that climate change is widespread, it's rapid. And then shortly thereafter, now you have Hurricane Ida and power outages in New Orleans and flooding in New York City. And also all summer, the fires in the West. What does that tell you about what investors need to think about where we are in today's environment and how to start really thinking about their portfolios?
Yeah, great question, Ed. And investors, as always, need to think about risk. But we're not talking about risk like Sharpe ratios. We're talking about future risk related to the 5 crises of our time. At HIP, we think about the world in 5 pillars: health, like physical and mental health; wealth, income and assets; earth, clean air, clean water; equality by gender, race, age; and trust. And that's based on Maslow's hierarchy of needs. And so the 5 crises of our time are crises of health and wealth and earth and equality and trust. And the report, the Code Red for Humanity report, affects all of them. It affects, obviously, the environment. So our earth is warming, and it is caused by people and a lot of people. We have a pandemic. Even last year in 2020, carbon emissions only dropped globally in the single digits. So there wasn't a massive cut in half or even 90% when everybody was staying at home. There's a crisis in wealth and wealth inequality, and that's going to get exacerbated as climate continues to change and evolve. There's a crisis in inequality, as we saw last summer as well. There's a crisis in trust. So not only a crisis in trust of government institutions, but even trust in science, that the science of biology or climate or nature. So these 5 crises should be on every investor's mind. And you mentioned the wildfires and the hurricanes in California, where I live. When the wildfires were persisting in 2018, 2019, we came up with a theme called decentralized self-sufficiency. And that really is, how a city or a community can be sustainable, but it's also, what do you do at your house? Do you grow your own food? How do you serve your own health? How do you do that in a sustainable way? So that is, all of these issues are risks for every business. I once had a debate with one of the SEC commissioners about, are greenhouse gas emissions appropriate to analyze for every company? The answer is yes, totally yes. Yeah, so future risk, that's how I'd sum it up, is investors need to look at, measure, and understand future risks and how they're going to adapt. What is the portfolio of 10, 20, 30, 40 years hence? How does that look different than today?
You talked about the regulators, you talked about the SEC. There's been increasing scrutiny from the SEC around the idea of greenwashing and things of that sort in terms of how funds present themselves. And then also, I guess, with regards to data accuracy, are there concerns about forcing companies to report this kind of data if there's some uncertainty about the accuracy of the data?
So for the past 15 years, all we've done at HIP is rate 10,000 global equities, 120,000 muni bond issuers, 700 REITs, asset-backed securities, mortgage-backed securities. So every investment has an impact. And the new term of art today in terms of environmental social governance, every business has an impact as well as every government and investment issuer. And the lowest scores of everything that we look at related to corporations are environmental issues. So corporations can be bad at paying people or good at paying people, but very few corporations are zero emissions, net zero emissions, or have a target like Stanley Black & Decker, for example, to be 100% greenhouse, net zero by 2030. So in less than a decade. And that would mean every year you have to reduce 8% compounded to hit that goal. And they probably have pressure to grow the business. So there needs to be a radical rethink of how businesses and any investment produces emissions, reduces emissions, and finds ways to be sustainable. My background is a forest here that we're having this conversation in. And nature doesn't make one-way systems. Nature makes closed loop or two-way systems. So there's a whole book about this. Somebody's waste is somebody else's food. And Janine Benyus writes about biomimicry. So we as a human species, thinking we're very smart, we have a lot of one-way systems, and those one-way systems need to be closed loop or need to be two-way systems where a waste stream flows into somebody else's energy input food stream in a positive way, not in a negative way. So in terms of data, companies have been producing and muni bond issuers have been producing financial statements, usually quarterly for corporates, annually for muni bond issuers, they vary. Many still don't regularly produce environmental, social governance data or data about health and wealth and earth and equality and trust. And those are all drivers of financial performance, future risk, and future return potential. So the good news is organizations like CDP, originally called the Carbon Disclosure Project, they've gotten hundreds and now thousands of companies to voluntarily disclose carbon emissions. So that is going up. But things like water, especially water sourcing, which is part of the new European Union taxonomy framework or the Sustainable Finance Disclosure Requirement, SFDR, most organizations don't know where their water comes from unless you're a water utility. So that's another one. And one of the things that we've seen occur, companies don't even know if they have a water leak sometimes because they don't get charged or get charged enough for water. So if there's no financial value to it. So that's why when we talk about like the price of ecosystem services, almost 2 decades ago, a group of scientists recorded if we paid nature, if we paid the bees for pollinating, if we paid soil for rejuvenating, if we paid for ecosystem services, it would be 2 times global GDP. So you take global GDP, it would be another 2 times. And that essentially makes almost every business negative profit. What we're seeing today with climate is, one, there's some financial costs and financial risks associated, but 2, we're threatening our own living systems. So there's a lot of investable opportunities, some of them very financially, compelling from a return on investment perspective, to improve and to make for a more sustainable corporation, a more sustainable city, a more sustainable community.
Let's talk a little bit about your background. When did you start HIP?
15 years ago, I started HIP, and our coming out party was in Fast Company magazine, where we rated 21 companies, including companies like Walmart and AMD and others. And the trigger for that is I was working at a nonprofit after doing for-profit consulting, and my first venture was a financial services fintech venture back in the late 90s. I was working for a nonprofit called Ashoka, and we funded social entrepreneurs around the world. So after looking at several microfinance models and looking at all the amazing work that these Ashoka social entrepreneurs were doing around the world, thousands across dozens of countries, the spark hit me that said, well, we have a human development index by the UN for countries, but we don't have a human development index for companies or for investments. And so the spark for HIP was, what if we could overlay impact sustainability metrics, data and metrics, and report it in daily financial media, Wall Street Journal or Barron's, and then compare. And what we found over time is that companies who are more sustainable, more transparent, higher performance, more accountable in health, wealth, earth, equality, and trust, that they generally have higher financial performance and lower risk. It's not every company, it's not every time period, but on average for a portfolio, it can be beneficial. And so I think we're seeing some of that play out today. And then about 10 years ago, a client asked us to rate muni bonds. And so we kicked that off 10 years ago. And so we've been doing that for almost a decade now. So the vision is your portfolio has an impact, positive or negative. You can even put it on something like a 100-point scale. 50 and above is net positive. 49 and below is net negative. And so if you think you're making a profit financially, you should test how you're making that profit. Are you paying people fairly? Have you set up a two-way system with the natural capital inputs of water and soil and food and energy and waste? And are you generating trust? It's possible to measure people, planet, and trust. The data is sometimes has to be, scraped for like an archaeology dig. And from time to time, there are institutions that lie. Enron was a big one. Volkswagen was another. They lied to the EPA about to try and trick them about not, how their cars were not polluting when they were. There's lots to analyze, and it's really exciting. And the next wave is analyzing all the full impacts of a product, like Tide cold water detergent was invented because it could save hot water. Stonyfield yogurt feeds its cows grass instead of corn. Lots of examples, sustainability examples, which we've put in our research and books over the years, as well as into our media articles that we've done with Fast Company and Barron's and others.
How would you characterize how HIP is different than other ESG rating providers? Is it that measurement of impact, or is it something else?
We have always focused on practice, like management, decision-making, and then performance. And so for us, performance is more important than policy. It's the performance of impact, sustainability, and responsibility. And those are measurable. A lot of people say, oh, isn't that tree hugging? Isn't that soft? There's lots of things that could be accused of being that way, but how people feel is a real feeling. So employee satisfaction or customer satisfaction is real. The transfer of energy among different elements, that's based on physics. So you can track energy in joules and watts and emissions in tons and kilotons, and water in cubic feet. So how HIP differs is one, this link between impact and profit, we always, profit potential, we always focus on. That's why we put it in our name. And at the beginning, it was just a test, like, does this exist? Is this true? And it turns out, when you hire the best people and you treat nature as a scarce resource and you build up trust, it turns out where that can be better for business and better for portfolios. Other companies sometimes will fill in the blank. Other data providers or ratings providers will fill in the blank, which is kind of like giving a failing student a C. We would never do it. We don't see the reason to do it besides to fill in besides the process of filling in the blank so that you don't have any missing data. But the truth is, Ed, that lack of transparency is one of the biggest issues, getting companies to at least count what they're doing in people, planet, and trust, and to measure it and to drive it down over time. The second one is customizability. Some investors want to customize to their own needs. So we're very flexible and customizable. And customers, clients, fund managers, advisors, they usually have requests. Can you look at this? Can you tilt it this way? The third is everybody at our firm, HIP Investor, everybody can talk to the client. And so if you have a question about data or ratings or applying something, you don't just go through a salesperson who may not know to get to an analyst who's infrequently talks to the client. So everybody's cross-trained and systems thinkers and adept at being able to explain how this can work. And then the last is we create good deals for customers. So we get renewals with customers because we treat them respectfully. We don't set overly high prices. We want to work with people for a long time, have lifelong relationships.
What types of customers do you have, or what types of institutions?
VanEck is a customer, so they're a customer of our ESG ratings and as Sustainable Development Goal ratings and climate ratings. Alliance Bernstein is a customer, so big financial institution. PIMCO has said explicitly that they're a customer of HIP. In addition, we have other advisors, Foundation Credit, who's very active in the muni bond market. And so it's a wide variety of fund managers, hedge funds, advisors, family offices, and Sierra Club Foundation is a client as well.
How would you characterize the demand for your type of services when you started and today, the difference between what that looks like? Have you noticed a major uptick in interest and adoption of sustainable investing or impact investing?
I mean, COVID was sort of letting the cork out of the keg, because with COVID, these crises of our time finally, revealed like we have a lot of improving to do. Also, the 2016 election sparked a lot of interest because that sent a signal, at least in the US, of, government may not solve our problems. We have to solve our own problems. And so we need to position our portfolios to solve our own problems. This type of investing has been, it's around for more than 100 years. It's a Quaker religious type investing. The nuns who wrote General Electric advanced this in the last half of the 20th century. The South Africa economic blockade to break apartheid. And so this field of investing has been active all along the way. What has shifted is those issues, which people thought were edge issues, or what we learn in economics, externalities, they're not externalities, they're internalities. We call it cradle to grave sometimes, but it's actually cradle to cradle, like the book. We are part of two-way systems, not one-way systems. And not enough of us have experience across sectors. Some of us just work in business, some just work in nonprofit, social sectors, some just in government. And there's other sectors, academia, military science. But when you cross sectors, so my personal background is I've worked on the Hanford nuclear site. If we turn out the lights, I might glow. I've worked for a nonprofit funding social entrepreneurs in 50 countries. I've worked for a family office. I've started my own company. So this cross-sector experience, when you visit other countries, when you serve not only customers, but beneficiaries or citizens, that was the trigger for me of helping businesses become more profitable is, one type of goal, but making the world a sustainable place for the generations to come. There's enough work for all of us to do. So it's really exciting to bring that to capital markets, because then it's not just doing the work, it's moving the capital. And so that's what we're all charged up about at HIP and with our clients, is using capital to make the world better and be economically sustainable and viable at the same time.
Yeah, do you feel like investors are more inclined or more open to pushing that agenda, or investing in a more sustainable way than they have been in the past?
Yes, more and more are. Part of this is there's an age shift now. And so it's funny, just the other day I was talking with some younger people just moving into San Francisco in their late 20s. And they had asked where I traveled around the world. And I started also talking about where I'd driven cross country several times and how people are generally friendly. And they said, well, if you're white, like they just volunteered that, right? And so it's like, well, yeah, I guess that is true. And so each of us come from our own experiences and biases. And the younger people today, they don't want unsustainable anything. They don't want underpaid. They want fair pay for everybody, $15 an hour and up. They want a earth that they and their kids and grandkids can live in. They don't want to fight the climate crisis alone. And they want to, help solve problems like all of us have done our whole lives, but they grew up on the internet. And so they see how everything's interconnected. Some of those younger people are part of multi-generational families. So those multi-generational families, including Rockefellers and Pritzkers, they are moving their capital in a more sustainable way. They want to have companies that are doing better. Beyond Meat is one, or Vital Farms is another. So they want investments that match that. And they want, to live in a sustainable city and community where it's not a stress. There's not a wildfire or hurricane, or the power is not knocked out in New Orleans for more than a week because all the transmission lines failed. Once you make the shift that your investment policy can include impact. And once you're open to the possibility, it opens up a whole new world of innovations and opportunities, and many of those directly linked to sustainability.
Now, we started out talking a little bit about companies and company sustainability and potential profit there and impact that they might have. So let's talk about places that we live. Let's talk about the cities. How do you look at different geographies or different cities in terms of sustainability? Is it different than, I assume it's different than the corporate world, different sets of data and what have you? And what opportunities are there for investors to consider more sustainable cities?
Right. So, let's talk about muni bonds. Muni bonds are issued by governments, but they're also issued by nonprofits, and they're issued by districts, like governmental districts. So munis are not only 19,000 cities and 3,000 counties in the US. Muni bonds are also hospitals. There's 4,000 hospitals that take Medicare, Medicaid payments. There's 50,000 water utilities. Before we started digging in deeper into the water utility, I didn't even know there were 50,000 water utilities. There's energy utilities, many of which are burning fossil fuel, so more so than even investor-owned utilities. Road authorities, kindergarten to 12 school districts, so all of us probably have kids, nieces, nephews in a school district, and then community colleges and universities. So each of those is seeking to achieve a goal. If you go to a hospital, if you got sick right now, would you care which hospital you went to? It would probably cross your mind. And some hospitals are better and some are more challenged. And part of that's determined by the case mix. So public hospitals deal with a wide variety, whereas some hospitals in higher income areas are more selective or only take patients who can pay or who have insurance. In schools, many of us pick houses where to live based on the school districts. So it depends on how kids learn and graduate and are safe on campus and the like, and including whether they have free or subsidized school lunches. So it's about mission accomplishment. And the interesting thing about running a city is there's a lot of missions in a city. There's a lot of issues to address there. So the usual question when it first comes up about muni bonds is, well, aren't all munis positive impact? And the answer is they can be. And we usually say, aren't all businesses profitable? Oh, no, not all businesses are profitable. So not all munis are impactful or as impactful as they could be. And then we look at what are the main missions, and both on an absolute performance, like how many kids should be in a classroom for optimal learning, which is in the high teens, 15, 16, 17, or, how do you get to patients not coming back to the hospital for the same procedure? How do you make sure that they're satisfied with the doctors and nurses? How do you ensure that transportation options are accommodating of biking and carpooling and super fast transport? There's a wide variety of services that we pay for and varying performance among all those 120,000 plus entities that are issuing funding and financing. And one of the dramatic challenges we will have is more than 200 cities have a climate action plan. Almost none of them are funded. So you have these unfunded mandates in cities and communities to reduce carbon, some of which is controlled through government-owned buildings, most of which is through corporates and nonprofits and other entities in that area. And so we need cross-sector partnerships as well as muni bond financing, private equity financing, venture capital financing, private debt financing, to start solving these problems, these 5 crises of our time. So there's a lot to evaluate. A second group of ways to look at it is through the UN Sustainable Development Goals. And so there's 17 UN Sustainable Development Goals, everything from no poverty to gender equality to sustainable cities is actually an SDG. And so when you look through those lenses, that actually sparks, I wonder if these organizations could work together. Companies are reporting on their SDGs now, so could muni bonds issuers and corporate issuers work together to fund some solutions in climate action or gender equality or no poverty? And then a third way that we look at the muni bond market and governments in general is climate. We've collected data from the EPA and other sources, as well as the Climate Policy Institute at Columbia University, to look at not only what the climate threats are, but what's the climate resilience? And what we find is, in the US at least, the South and Southeast, as well as coastal areas and other areas, but not only are challenged on governments delivering great services, sometimes because there's not enough tax base. Not only are they not achieving their missions, but they're also at risk of climate and of COVID. So you have this triple whammy combination, whether it be Miami and the sea level rise and now collapsing commercial buildings, to hurricanes in Louisiana and Texas, to just underinvestment in education in Mississippi and Alabama. So the challenge for investors is, okay, these places probably need capital, but who's best at deploying that capital and managing that capital for the outcome? Because sometimes when you throw money at it, money gets wasted. So who will be the best at implementing solutions with that capital?
How do you determine who would be the best in implementing that capital, just based on what results they've had so far? I mean, I guess the end goal for some of these municipalities would be to initiate some of these projects so that they can retain and attract citizens to maintain a broader tax base and continue to support those services. And
yeah, so there's a couple ways to look at it. So one is, what is the mission accomplishment today? And so higher rated areas, there are, low income school districts in South Carolina that do a super job of educating students. There's also high income muni bond issuers that don't do a great job. That's one way to do like a first cut. And then a second way is to say, who's improving? And so which energy utilities in the Midwest, in Pennsylvania, West Virginia, Ohio, are moving out of high sulfur coal into better energy solutions? So that's the second way, is looking at momentum. What's the change in our HIP rating or SDG rating or climate rating? And then a third is how to blend all those together. So sometimes you could blend adjacent areas if they're solving a particular problem. And you can blend that into a mix of risk and impact for a portfolio. It also depends on the desires of the investors. So some investors, especially impact-minded investors, will say, I just want to allocate to the widest gap areas. And so if you can compare that with or help illuminate the intersection of some wider gaps with some acceptable credit ratings, those could be part of a portfolio. But what has emerged is a next iteration of financial instrument, things called social impact bonds or environmental impact bonds. And this is where there's actual measurement of the results. In munis, we sometimes get annual financial reports, usually, and then unknown cadence of impact reporting. So what environmental impact bonds do is, whether it's in Washington, D.C. or Atlanta or City of Buffalo, is they measure the change in environmental performance linked to the capital of that bond, and then can reward or penalize with capital the entities doing that or not doing that. And so now you have this level of accountability in the financial instrument. And I think we're going to see more of that. I think we're going to see more accountability and more metrics tied to specific financing instruments, not just at the enterprise level, but at a financing by financing level.
Do good ratings, good HIP ratings for an issuer translate into credit dynamics? Do they tend to be better credits, or is that irrelevant?
So here's another interesting thing. Remember, we said hospitals could be higher low income and higher low impact. Same thing in schools. It's the same thing with credit ratings. So state of Texas has a AAA credit rating historically, but Texas is not doing a great job at improving the health of its citizens, the wealth of its citizens, the environmental condition. Remember, Houston flooded massively during a previous hurricane, and there's not improvements that the state of Texas is making on that. So that's a good, very good credit rating that has a low impact rating. So it's challenging to invest in a Texas state bond if you're considering impact. And remember, at the top of the interview, we were talking about future risk, the 5 crises of our time. What's coming? What will the world look like in 10 or 20 or 30 years? Bonds are 10, 20, 30, 40-year instruments. And so if you're holding for that duration, you need to be thinking what is going to happen in 1, 2, 3, and 4 decades. And then there's some unrated parts of the muni market, and those definitely need capital. Mid-sized cities and small cities need capital. They either can't or won't pay for a credit rating. There are some investors who will play in that part of the market of unrated securities, but they're doing a great job at their mission and impact. So this creates a wider universe for investors to draw from now. And a lot of that is local place-based investing. And so that local place-based investing in a community, in a city that can be more sustainable, in a state, in a cross-state, cross-county area, those solutions can be brought together in different financing instruments. So it's a really exciting time for capital markets to integrate and layer in impact with data-driven metrics of actual performance that sometimes is challenging to close the gap on transparency. But if you can't see it, we can't just trust. We have to trust but verify. And so what we do at HIP and our team does is to make sure that there's hard data on what missions are being accomplished across all asset classes that can fit into an evaluation of future risk that many times can also contribute to the strength or resilience of a portfolio, as well as build a better world.
And you're looking at individual issues, right? Not necessarily just a city, and the city gets a rating and everything that the issue is at that rating.
Yeah, as of the date of this interview, we've done that for more than 170,000 different issuances. So we're looking at the use of proceeds and which of those are, green bonds or blue bonds or environmental impact bonds or social impact bonds, or, what lottery bonds there are that are funding schools. Are there tobacco bonds, and are those tobacco funds being used for actual health and wellness, which almost not as many do as you might hope for. So looking at the use of proceeds and the construction of what that capital is going to be used for, that's part of what our team does.
Let's start to wrap it up a little bit. I wanted to ask you, what is one long-term trend you see playing out over the next year or several years?
Well, many trends playing out. I'd say investors being active with their money to solve problems, to solve people, planet, and trust problems, whether they be in health or wealth or earth or equality or trust. That's one big trend. So it's already $1 out of $3, a lot more in Europe than the Americas than in Asia. That will continue to be a big trend across asset classes. Another is we're in a climate emergency. We're in a climate crisis. We have hurricanes, sea level rise, heat, extreme cold. And so we're seeing how the underinvestment in our infrastructure or the design of how electricity is bought and sold in Texas. Some Texas residents got bills for tens of thousands of dollars when the power went out because they were buying variably priced power instead of fixed price power. That's what bankrupted the state of California back when that happened with Enron. The design of how capital flows and how people buy goods and services is another one. And so I'd say another trend is decentralized self-sufficiency. So seeking out sustainable cities, communities, and corporations that can be self-sufficient. Historically, when a hurricane hits the South, the Walmart trucks are en route into or right after the hurricane and usually arrive before FEMA, bringing Pop-Tarts and beer, because those are the two biggest sellers post-hurricane, Pop-Tarts in the toaster and beer as a beverage that you can drink safely because you don't know about the water. So I'd say those are two big trends: investors using their capital, decentralized self-sufficiency, and then the continued measurement of people, planet, and trust.
All right, so let's move on to trend or fad. Space tourism investing, trend or fad?
Fad.
Cryptocurrencies, trend or fad?
Trend.
Alternative protein, trend or fad?
Oh, trend, big trend.
And pet wipes, trend or fad?
I'm not aware, so I'll call it a fad.
I would have not even considered that one until I actually saw it this weekend. Somebody wiping their little dog's tush after he'd done his business. I'm like, no way.
Don't underestimate the ability of pets to be part of the family. We have ours as well. No pet wipe, but that's what her tongue is for.
Yeah.
And our rug.
Well, on that note, Paul, thank you very much. This was a blast. I enjoyed talking to you, and it's very informative.
Same here, Ed. I'm just really grateful for the opportunity to dive deeper, to share with the audience how you can be impactful with your portfolio. And we've been doing this for 15 years, and I'll be doing this for the rest of my life. So there's lots of problems to solve, and we can do it through our portfolio. So thanks for the opportunity to work with you and the VanEck team.
And what's the best way for people to find you and connect with you?
Sure. We have a newly launched website, hipinvestor.com, and we're on LinkedIn and Twitter. Feel free to contact us.
Perfect. Thanks again. And thank you for tuning in to another episode of Trends with Benefits.